Title: Harnessing Value. The impact of corporate share buybacks on stock price and earnings per share. Introduction. In the intricate realm of corporate finance, the strategic maneuver of share buybacks has emerged as a potent tool for companies seeking to enhance shareholder value. The impact of corporate share buybacks extends beyond the simple act of repurchasing shares from the open market. It intricately weaves into a company's stock price dynamics and its earnings per share, EPS, prompting investors to scrutinize these maneuvers for insights into a company's financial health and growth prospects. Understanding share buybacks. At its core, a share buyback, or stock repurchase, occurs when a company uses its own cash reserves or borrows funds to buy back its outstanding shares from the open market. This strategic move can be driven by various motives, including signaling undervaluation, returning excess cash to shareholders, or bolstering earnings per share. Stock price dynamics. One of the most immediate impacts of share buybacks is their influence on a company's stock price. The reduction in the number of outstanding shares through buybacks often leads to an increase in earnings per share, ceteris paribus. This, in turn, makes each remaining share more valuable, potentially lifting the company's stock price. Consider a company with a market capitalization of $1 billion and 100 million outstanding shares, resulting in an EPS of $10. If the company repurchases 10 million shares, keeping its earnings constant, the EPS would rise to $11. This increase in earnings per share could translate into an uptick in investor confidence, potentially driving the stock price higher. Earnings per share enhancement. The relationship between share buybacks and earnings per share is symbiotic. As companies repurchase shares, the denominator in the EPS calculation decreases, automatically boosting the EPS figure. This financial engineering technique is particularly appealing to companies seeking to demonstrate improved financial metrics to investors without a corresponding increase in net income. For instance, if a company's net income remains constant at $100 million but it buys back 10 million shares, the EPS would rise from $1 to $1.11. This apparent enhancement in per-share profitability can be a compelling narrative for companies aiming to attract investors and showcase robust financial performance. Return on investment and shareholder value. While the impact on EPS is evident, the overall impact on shareholder value hinges on the effectiveness of the share buyback strategy. Companies executing well-timed buybacks, especially when shares are undervalued, can yield a positive return on investment for shareholders. The increase in stock price, coupled with the EPS boost, contributes to a holistic enhancement of shareholder wealth. Conversely, poorly executed buybacks, such as those conducted at inflated stock prices, may fail to deliver the desired value. Investors scrutinize the rationale behind buybacks, evaluating whether they reflect management's confidence in the company's future or are merely a short-term measure to buoy the stock price. Balancing act: debt, opportunity cost, and investment alternatives. The decision to engage in share buybacks involves a delicate balancing act, considering factors such as debt levels, opportunity costs, and alternative investment opportunities. Companies often fund share repurchases through a combination of cash reserves and debt. While this strategy can enhance shareholder value, excessive leveraging or diverting funds from growth initiatives may compromise a company's long-term prospects. Consider a scenario where a company opts for share buybacks instead of investing in research and development, entering new markets, or acquiring innovative technologies. While this may lead to a short-term boost in stock price and EPS, the long-term impact on the company's competitive position and growth trajectory must be carefully weighed. Market perception and signals. The market closely monitors share buyback announcements for signals about a company's financial health and future prospects. A well-timed buyback can signal to investors that the company views its stock as undervalued and believes in its ability to generate sustainable future earnings. On the contrary, a hasty or poorly executed buyback may raise questions about management's decision-making and the company's strategic direction. Consider a company that initiates a share buyback program during a market downturn when its stock is trading at a substantial discount. This proactive move may instill confidence in investors, signaling that the company is seizing the opportunity to enhance shareholder value during a market dislocation. Conclusion. Corporate share buybacks, when executed judiciously, can be a powerful tool for enhancing shareholder value, elevating stock prices, and bolstering earnings per share. However, the impact of these financial maneuvers transcends mere numerical metrics, delving into the intricacies of strategic decision-making, market perceptions, and long-term sustainability. As investors navigate the dynamic landscape of corporate finance, a nuanced understanding of the implications of share buybacks is essential. Companies, in turn, must tread carefully, ensuring that their capital allocation strategies align with long-term growth objectives. Maintaining a delicate equilibrium between short-term gains and sustained shareholder value.